the reserve currency erosion mechanism, how the slow, structural decline of US dollar dominance reallocates global wealth, destabilizes foreign reserves, and forces a fundamental repricing of every asset class on Earth. In March of 2023, something happened that almost no mainstream outlet covered with the weight it deserved. Saudi Arabia, one of the United States' most important geopolitical and economic partners, openly announced it was willing to settle oil trades in currencies other than the US, quietly, without fanfare, almost as if they didn't want you to notice. And you probably didn't. But here's what that moment actually was. It was a crack in the foundation of the most powerful financial architecture ever built. An architecture that has governed global trade, global debt, and global wealth for over 80 years. Now, let me ask you something directly. What if the single asset you were told was the safest on Earth, the asset that every central bank holds, that every international contract is priced in, that every global trade passes through? What if that asset were quietly losing its grip on power? What would happen to your savings? What would happen to your mortgage rate, your retirement account, your purchasing power next year? You're watching the answer unfold in real time, and most people have absolutely no idea. Here's the paradox at the center of this story. The US dollar is simultaneously the world's most trusted currency and the world's most dangerous systemic risk. It is trusted because 58% of global foreign exchange reserves are held in dollars, according to IMF data from 2024, because commodity markets, oil, gold, wheat, are predominantly priced in dollars. Because when global fear spikes, money flows into the dollar as a safe haven, and yet it is dangerous for exactly the same reasons. Because when a currency is that deeply embedded in global trade, any meaningful erosion of confidence doesn't just hurt exchange rates. It reprices everything. From the global financial system from the ground up. That is what we're going to explore today. Not a crash, not a sudden collapse. Something far more insidious, a slow structural decline, and what it means for your money, your portfolio, and your financial future. Stay with me, because by the end of this video, you will see the dollar and your own finances in a way you cannot unsee. To understand what's happening to the dollar, you need to understand three core mechanisms. These aren't abstract academic concepts. They are the live wires running underneath global finance right now. A reserve currency is the currency that other nations hold in their foreign exchange reserves and use to conduct international trade. Since the Bretton Woods Agreement of 1944, that currency has been the US dollar. But here is the structural trap buried inside that privilege. It's called the Triffin dilemma, named after economist Robert Triffin, who identified it in 1960. To supply the world with enough dollars to function, to lubricate global trade, to fund emerging market debt, to fill reserve coffers from Beijing to Riyadh, the United States must run persistent trade deficits. It must export more dollars than it takes in. It must spend more than it earns. And that spending over decades hollows out domestic manufacturing, inflates the money supply, and gradually, incrementally, erodes the credibility of the currency itself. The dollar's greatest strength is also its structural death sentence. That is the Triffin dilemma in action. Since 1974, the global oil market has operated on a handshake agreement between the United States and OPEC nations, particularly Saudi Arabia, that oil would be priced and settled exclusively in US dollars. This created what economists call the petrodollar system. The consequences were enormous. Every country that wanted to buy oil, which is every country, needed to hold dollar reserves. This created a structural, perpetual demand for the dollar that had nothing to do with American economic output and everything to do with geopolitical architecture. That architecture is now fracturing. In 2023, China settled its first LNG trade with France in yuan. The BRICS nations, Brazil, Russia, India, China, South Africa, and now several new members, have been actively developing alternative payment systems that bypass sub-UIFT and the dollar entirely. The IMF's own data shows the dollar's share of global reserves has fallen from 71% in 1999 to approximately 58% in 2024. That's not a rounding error. That's a 13 percentage point structural shift over 25 years, slow, quiet, and accelerating. Between February 2020 and April 2022, the U.S. M2 money supply, the broadest measure of money in circulation, expanded by over 6 trillion. To put that in context, it took the United States over 200 years to build the first 6x trillion in money supply. They replicated that in 26 months. The result was not simply inflation. It was a fundamental repricing of every asset class, calibrated against a dollar that was, in real terms, worth less than it was before. When central banks expand money supply faster than economic output grows, the real value of every dollar, denominated asset, declines, even if the nominal number stays the same. This is what economists call monetary debasement. And it is one of the oldest forms of wealth transfer in human history, from savers to debtors to governments. You may not feel it as a single event, but you feel it every time you pay for groceries, every time your rent renews, every time your salary raise doesn't quite cover what it used to. That is the dollar's quiet collapse, measured not in headlines, but in purchasing power quarter by quarter. Now let's talk about real cost, because this isn't just macroeconomic theory. This is hitting real people, real portfolios, and real economies in ways that most financial media refuses to quantify with honesty. Ray Dalio, founder of Bridgewater Associates, the world's largest hedge fund, has been sounding this alarm for years. In his landmark work, Principles for Dealing with the Changing World Order, Dalio writes that every dominant reserve currency in history has followed the same arc: rise, overextension, debasement, decline. The Dutch guilder, the British pound, and now the US dollar. His conclusion is not that the dollar will disappear overnight. His conclusion is that we are in the late stage of a long-term debt cycle where the accumulated weight of dollar-denominated obligations becomes structurally unsustainable. The U.S. national debt crossed to $34 trillion in January 2024. The Congressional Budget Office projects that by 2034, interest payments alone on that debt will exceed $1.6 trillion per year, more than the entire current U.S. defense budget. That is a country paying more to service its past than to invest in its future. Here is where it gets personal. Here is the invisible financial loss, the cost most people never see until it's already happened. When a currency loses reserve status, not overnight, but over years, global demand for dollar-denominated assets declines. U.S. Treasury bonds, which foreign nations hold as reserve assets, begin to be sold. Yields rise. Mortgage rates rise. Consumer borrowing costs rise. The cost of financing the U.S. government's own debt rises. The feedback loop looks like this. Dollar loses ground. Gay Treasury demand falls. Gay interest rates rise. Federal deficit grows. More dollars must be printed. Dollar loses ground further. This is not a hypothetical. This is a mechanism that has played out to varying degrees in the United Kingdom after World War II, in Japan across the 1990s, and in dozens of emerging market economies throughout the 20th century. The fear mechanism operating here is currency devaluation fear, distinct from inflation fear because it operates at the macro level. It is the fear that the unit of account itself is broken. And when that fear takes hold in global markets, it does not move slowly. It moves in cascade. The quiet truth that institutional investors are already pricing in, while retail investors are still watching the S&P 500, is this: a weaker dollar structurally benefits dollar-priced hard assets, commodity exporters, and non-dollar denominated equity markets, and it structurally penalizes dollar-denominated bonds, cash savers, and anyone whose wealth is concentrated in U.S. fixed income. The average American household holding cash savings, a 400 wonk weighted toward U.S. equities and bonds, and a mortgage, is almost entirely exposed to dollar erosion, and almost entirely unhedged against it. Let's get specific. Because abstract macro risk means nothing until you see it reflected in your own financial life. 60% U.S. equities, 40% U.S. bonds. Here's what happened to your net worth. You experienced one of the worst drawdowns since 1937. Stocks fell over 18%. Bonds fell over 13%. The traditional, safe allocation, the one every financial advisor recommended, failed simultaneously on both legs for the first time in a generation. Why? Because both assets were repriced against a dollar that was itself being questioned. The correlation between stocks and bonds broke down, not because of company fundamentals, but because of a macro-monetary event that conventional portfolio theory was never built to survive. Experience the following. Real returns on cash savings turned deeply negative as CPI inflation hit 9.1% in June 2022, the highest reading since 1981. A savings account or percent against 9.1% inflation meant a real annual loss of 8.6 cents on every dollar. Silent, invisible, devastating at scale. Here are 6 precise symptoms of dollar erosion playing out right now across different dimensions of financial life. The classic diversification model assumes that when equities fall, bonds rise. Dollar erosion breaks this assumption. When the currency itself is under pressure, investors don't flee to treasury bonds. They flee to other currencies, to gold, to commodities. Your portfolio's diversification may be an illusion built on a correlation that no longer holds. Industries most exposed to dollar-denominated global trade, import-heavy retailers, airlines with dollar-priced fuel contracts, U.S. multinationals with overseas revenue, face margin compression when the dollar weakens irregularly. This isn't just a Wall Street problem. It ripples into hiring freezes, bonus clawbacks, and restructuring events. Beyond inflation, dollar weakness increases the probability of what economists call financial repression, where governments use negative real interest rates, capital controls, or bail-in mechanisms to recapitalize the system at depositors' expense. This is not a conspiracy theory. It happened in Cyprus in 2013. It has been formally proposed in IMF working papers. When dollar erosion accelerates, retail investors tend to panic, sell their most liquid assets first, equities, and hold cash. This is precisely the wrong move. Selling productive assets for a depreciating currency is a behavioral trap that transfers wealth from the uninformed to the positioned. Most investors anchor their risk models to the last decade, a period of dollar strength, low inflation, and expanding multiples. Anchoring to 2021 as normal is one of the most dangerous cognitive biases operating in markets today. The conditions that generated those returns no longer exist. The dollar's role in global collateral chains means that as its value erodes, the notional value of dollar-denominated collateral underpinning trillions in derivatives contracts also erodes. This is called rehypothecation risk, the risk that the same collateral has been pledged multiple times across the financial system. When the value of the underlying asset declines, the entire chain can unwind in ways that nobody, individually, can predict. Here is the most important reframe. These are not personal failures. These are rational responses to an irrational system. A system that was never designed to be transparent about its own fragility. The beginning of financial intelligence is not avoiding loss. It is witnessing the mechanics of the system clearly enough to stop being surprised by the outcomes it generates. You are in that process right now. The unlearning has already begun. If your portfolio is dominated by U.S. equities and U.S. dollar-denominated bonds, you are implicitly making a single macro bet that dollar dominance continues indefinitely. That bet is increasingly asymmetric. Consider deliberate allocation to international equities and economies with current account surpluses: Japan, Germany, Singapore. Commodity-producing nations: Canada, Australia, Brazil, and inflation-linked securities such as TIPS, Treasury inflation, protected securities, which adjust with CPI rather than holding a fixed nominal rate. The goal is not to abandon U.S. assets. It is to reduce the concentration of a single currency risk in your total net worth. Dollar erosion doesn't move in a straight line. It comes in episodes of sharp repricing. Hedging against those episodes requires instruments that appreciate during volatility, not after it. These include long-dated put options on the US dollar index at DXY, inverse ETFs on long-duration treasury bonds, physical gold or gold-backed ETFs such as GLD or SCOL, and carefully sized allocations to Bitcoin, which, despite its volatility, has demonstrated a structural inverse relationship with real U.S. interest rates over multi-year periods. None of these are speculative bets on catastrophe. They are insurance positions in a portfolio, small in allocation, significant in payoff during stress events. Preserve your decision-making capacity under stress by structuring your liquid assets into 3 buckets. 3 to 6 months of expenses in a high-yield savings account or money market fund. This is your operational reserve. Never invest it. 1-3 years of medium-term needs in short duration, high-quality bonds or T-bills. This is your stability buffer. Preserve it. Everything beyond that is your long-term capital, deployed in diversified, inflation-resistant, globally uncorrelated assets. This is where growth happens. This structure ensures that a market dislocation, even a severe one, never forces you to sell long-term assets at the worst possible time. Liquidity is not just cash, it is optionality. And optionality is the most underpriced asset in a collapsing currency environment. Test your portfolio against historical scenarios. Before the next crisis arrives, simulate what your current portfolio would have returned during the 1973 oil shock and dollar devaluation, the 1994 bond market massacre, the 2008 global financial crisis, and the 2022 simultaneous equity bond sell-off. If your portfolio would have been down more than 30%, in any of those scenarios, you are carrying more risk than you likely believe. Stress testing is not pessimism. It is the most rational act of financial self-defense available to you. I want to leave you with one thought from John Maynard Keynes, the economist whose frameworks built the modern global financial order. The market can remain irrational longer than you can remain solvent. The corollary for today is this: the dollar can remain dominant longer than its structural weaknesses suggest, and it can also unravel faster than anyone's comfortable scenario assumes. The goal is not to predict which outcome arrives first. The goal is to be prepared for every outcome the market delivers. That is not fear. That is precision. That is what separates the investor from the spectator.